A very good afternoon, good morning, good afternoon, Max. Thank you very much. Good to see you. If you can just let me know my screen and voice are coming through okay, that would be super. Welcome, Ignatius, John. Good to have you here. Thanks, Max. That's super. Always good to have the confirmation. Right. Let's get stuck into the session. And don't forget, as we look at different entries, exits, different trading instruments, now this is trading advice. The whole idea, it's educational service. So you look over someone with a professional trading background, you see how I go about making trading decisions. The workshop we're looking at is trading the US Core PCE data. Remember, the fundamentals that we're looking for is to back strength against weakness. So just as we'd expect a strong arm to beat a weak arm, we are looking to back a strong currency against a weak currency. And I want to show you an opportunity that we have right now at market, and I just want to run that through with you. Okay, so you have to bear with me, but I'll explain to you why there is a dollar-yen upside bias and just how stops can be nicely defined and limited as we head into the Jackson Hole meeting. Now, look at the dollar-yen. I was talking to my community yesterday about buying dollar-yen from this region here, this 13637 region. Now, this is suitable to buy at market now. We got that technically, we got that lovely 1-2 touches. That is a probable trend line. And what we see there is some support around that level, and that's where we can define and limit risk. Now, let me explain to you what went on. Now, yesterday we had the dollar-yen moving sharply lower. That was on some disappointing data points out of the US. I'll just show you that run of data, and it will make a lot of sense to you when you see what was going on. Yesterday, we had new home sales, big, massive slowdown, and global services PMI flash, massive slowdown, 44.1, well below the minimum expected of 47. So global composite flash 45, and if you just take a look at the global composite readings across major world economies, you can see that what we're starting to see now is a coordinated global slowdown, US coming in there, that 45 region. Now, that slowdown is indicative of slowing global growth. We've got the world stock index dropping below that 100 moving average. And expectations is that growth is slowing. Now, at the same time, and also you can see euro area recession warning growing with some very weak PMI prints, flash PMI prints out yesterday as well for the euro. Now, this is just the US data that I've got displayed here. Now, what I want to show you is this latest print we've just had. So these durable goods orders, they're quite robust. Now, if you look through the course of since the last Fed meeting, right, we've seen a real mix of data. At the last Federal Reserve meeting, Jerome Powell said that yes, there's some signs of slowdown in the US economy, and Jerome Powell said that we're moving to a meeting by meeting basis. Since that meeting, and that meeting came 26th, 27th of July, you can see their Fed interest rate decision, had the press conference. We then had a real mix of data. So the next day you can see it's green, red, mix of US data. PCE is still high, so inflation
commenting on inflationary expectations
still to the upside. We had a big miss in the ISM manufacturing prices. That was down. That was positive because it just means that there's less inflationary pressures. But global PMI missed. ISM manufacturing employment above maximum expectations. That was a positive print. We then had that good services print early in August, and 56.7, well above the maximum expected. So that was strong. We then had continuing jobless claims slightly higher than expected, up towards the maximum. Initial jobless claims just above forecast, so slightly worse data, but still pretty acceptable. We had that stunning NFP data with headline 528, well above the 325 maximum expected. and then we also saw inflation falling, so that's good. That's looking like potentially peak inflation. But then we had, and then that was reinforced by the PPI data with 9.8% showing producers are having less pressure on them. And then we had that really weak New York Empire State Manufacturing Index, which is in contrast to the really high Michigan consumer expectations. Then we saw housing starts fall, building permits fall, but yet industrial production and manufacturing production was up above maximum expected. Retail sales, a decent beat, but a miss on the month-on-month reading. We then had that big miss in US existing home sales, slowdown in the growth, but Fed manufacturing index above market expectations. And then yesterday we had this slowing global services PMI, well below minimum expectation of 47 at 44.1, and a general miss across the board. So it's been a real mixed print. And the expectations at the moment are that the Federal Reserve are going to have to be more hawkish, that they're going to have to push back against July's meeting. Now, you see this print here, that's good again, right? Durable goods orders. So that means the US economy can take interest rate hikes. That's why I'm expecting the dollar yen to rise from here into the Jackson Hole Symposium. So that's why I'm long the dollar yen. I've been long this morning. I entered long there yesterday, and then when price hovered around, because what I wasn't sure of was, would markets think that that data is so bad that the Fed will have to pause? Whereas now what we've got is that durable goods orders has come in saying, okay, that undoes some of the negativity of that data yesterday, and the firm expectations, and this was confirmed by Fed's Kaskari last night, that where he said that the Fed's going to have to, be quite clear, they've got to tackle inflation and keep tightening monetary policy. So if you look at stocks, you see how after the meeting, 27th of July, do you see how stocks had that rally, right? Since the 27th of July, that rally higher, that was on expectations that the Fed might be less dovish. Now expectations is that the Fed's going to have to be hawkish. And we've had string after string of a Fed speaker saying we've got to get tough on inflation, we've got to get tough on inflation, we've got to get tough on inflation. So that means that we're expecting 10-year yields to keep rising. And don't forget, with 10-year yields, when the 10-year yields rises, that weakens the yen. All right. So if you just take a look at this basket, let me just show you the basket, the yen basket. Let me find it. Where's it gone? Just gonna find my yen. Yeah. Okay. So let's look at the yen basket. If I just you look at 10-year yields, you can see very clearly that when 10-year yields rises, that weakens the yen. Let's just go to daily. It makes it a bit easier. Yeah, you can see it on the monthly there. That so rising 10-year yields, weakening yen. Falling 10-year yields, strengthening yen. Okay. Rising 10-year yields, weakening yen. This is the yen basket in the candlestick chart. Okay. Rising 10-year yields, weakening yen. Falling 10-year yields, strengthening yen, right? So at the moment, 10-year yields are pushing up. So what does that do? That weakens the yen. What does that mean for dollar yen? It means more upside. So therefore, we're expecting more upside in the dollar yen in expectations of a more hawkish Powell. We're going to try and run this into Friday. So the beauty of the technicals will come together. You can just see, look, you can easily define and limit your risk just underneath that 13550 region. If you look here, you can see even on the hourly chart, you've got S1 pivot point, you've got 200 exponential moving average. You can just pop your stops to the other side of that region. The chances of price going through the trend line, the S1, and hitting your stop there, you've got to go through the S1 daily pivot, the 200 exponential moving average, and the trend line. That's really solid support, because you have traders leaning against the trend line, you have traders leaning against the S1, you have traders leaning against 200 exponential moving average. So it's low risk, high reward. Where could you potentially run up to? Well, it's possible you could make a run back up to that 138 or 139 region up ahead. So it's low risk, high reward, and is in keeping with the fundamental picture. Phew, got there in the end. I wanted to share that with you quickly first off the bat, because that was the tradable outcome of that durable goods orders. Now, in theory, we're looking at that, trading this core PCE print, but really what we want to be focusing on here is not the core PCE print, but the Fed communication. I'm going to show with you the best opportunities that there are ahead. I'm going to be a bit of a whistle-stop tour, but you need to understand this dynamic. So if Jerome Powell is hawkish, then we expect a further continuation of what we've been seeing. That's pressure to equity markets to the downside. But a lot of that is priced in now. So in order for the Jerome Powell to be even more hawkish, what he's going to have to say, look, there's a definite 75 basis point rate hike coming. Okay. So let me just show you here. There's about, I think it's 83% chance of a 75 basis point rate hike in sterling markets at the moment. Let's just have a look. Yeah, 83% chance of a 75 basis point rate hike in sterling market. So for Powell to be more hawkish, he's got to say there's definitely a 75 basis point rate hike coming. And that should, if he does that, that should lift the dollar yen higher. So hawkish Powell, the go-to pair would be upside dollar yen or selling gold or selling silver. Okay, that's the best opportunity on a hawkish Powell. Now, the best opportunity far and away will come from a dovish Powell. Okay, so if Jerome Powell on Friday says, oh, you know, we are starting, you know, he starts saying, well, look at the services PMI data, look at that New York Empire manufacturing, we've got problems in the manufacturing sector, you know, or where is it? It came in on Monday, didn't it? Yeah, New York Empire State manufacturing, gosh, you know, we're really seeing a slowdown in manufacturing and the housing market's looking stressed, and you know, bearing in mind we've got NFP next week, then we could see Jerome Powell make a dovish pivot. And if he goes back to what he said around July, and you remember July, we sort of rally higher in stocks. So if it's a dovish pivot, we'd expect stocks to rally higher. Now I sold the Dow. You make sure you follow me on Twitter, because I put this up on my Twitter feed here. So if you're not following me on Twitter, you need to be, and that's what I put, you know, this was the original tweet that I printed out on August 19th. Dow selling at market makes sense with calling inside bars, breaking lower from key daily resistance and growing expectations of a hawkish Powell at Jackson Hole next week. Bond sell-off in bunds and gilts, stocks can be easily placed above 3,400. So that's what I sold at market, stops just above there, you see? And you can see, this is my Twitter handle, it's at Giles Cochran CCA. I'll just put that in the comments. If you're not following me there, you can follow along so you don't, you know, so you don't miss anything. It's important. I've closed those out now because kind of the expectations are there, and I feel like I've got a good run, you know, low in the Dow. So I sold there, and I sold it, closed it yesterday, somewhere around this sort of 300 region. I can't remember exactly where. Nice little run. So now what we're doing, we're still looking at those hawkish expectations. We've just got a nice place to define and limit our risk. And you can see the dollar yen sort of tracking higher now, which is kind of, you know, it's what you'd expect on the data, really. And you can expect to see like a run potentially higher. And if this is a Harami inside bar, then you expect that to break higher and maybe have a pop at 139 for Friday. Yeah, it looks pretty decent. Obviously, there's always a risk. The risk to this is if you get some indication that the Fed will be more dovish, then that will send this lower. Now, if we get a dovish Powell, these are the best trades to look at. Gold-silver ratio is very high. So that means when the gold-silver ratio is high, it means that silver is primed to outperform gold. Silver here, you see when the ratio is high, silver can surge. High ratio, silver surges. High ratio, silver surges. What are we seeing here? High ratio, what should silver do? Should surge. We're just waiting for the fundamental conditions to be right. At the moment, the fundamental conditions are wrong, okay? And the wrong thing about the fundamental conditions is that yields are pushing higher, dollars pushing higher, that's negative for silver. A dovish power would reverse that, so silver longs would be very attractive at market on a dovish power. Gold longs would also be good. Another trade that would be worth looking at would be pound yen and euro yen shorts. Very dovish outlook for the UK. We've had this situation where Bank of England, their last interest rate meeting, and do check out my blog, hycmlab.com, there's loads of information I put up there, had a dovish outlook. They brought forward recession projections from 2023 to 2022. Recession is now expected to extend 5 quarters. Cost of living crisis, energy price caps going up on Friday here in the UK. Growing political pressure, growing inflationary pressure, with Bank of England expecting inflation to, be peaking around over 13% now. Some investment analysts I've been saying they've been seeing a case for inflation at 16%. Can you believe it? So pound yen selling makes sense, but just look at this little trend line here. Let me show you. Just get rid of that. Now, so the trade would be dovish pound, go with the break of that trend line, stops above the high. Euro yen on a dovish pound. Euro yen short 2 makes a lot of sense. Right, so just the break, I would narrow that trend line in, right, and just take that. If you get that, and the break of the 200 exponential move average, go with the break, and the close stops just at the other side of it. So dovish pound, euro yen shorts, pound yen shorts, gold long, silver long, and euro US dollar long, because you expect that the dollar to collapse, and that should boost the euro US dollar higher. But my preferred trade would be silver first, pound yen second, tied with euro yen, and then euro US dollar long last of all. Now, what else is there to say here? Okay, folks, I think that's it. Has anyone got any questions? What questions do you have? What questions do you have about what I've been sharing? Speak now, so I can help as best as possible. A lot of this has been quite straightforward. I've been following this in some detail over the last couple of weeks. Just going to give folks a little bit of time. Yeah, the only other thing I say is don't initiate new trade. Oh, yeah, okay, nice one, Max. Thoughts on Aussie and Kiwi? Yeah, okay, so today, if you notice, you'll see here, Max. Do you see when we've had these recent falls in European and US equity futures, but China's 50 has been holding up? But today, look at the China 50. It's fallen 1.56%. That's been on negative property news. Property sector in China is a big thorn in the side of China. Now, Beijing keep promising different schemes and plans to prop up the property sector. People's Bank of China cut interest rates, the loan prime rate by 5 basis points on Monday, the 5-year loan prime rate by 15 basis points, which is the rate for setting mortgages. But all of that still hasn't really massively supported China's 50 because negative news out today. One of the big property names, risk of default and weaker earnings in property developers that have released their earnings. And there's a few, retail property retail executives who are being investigated for, their activity problems afoot. So when China's sentiment is negative, right, and you get iron ore pushing lower and copper, that weighs on Antipodeans like the Aussie. So if you notice let's just show you here. Yeah, if you notice currencies, you'll see that Aussie and New Zealand dollar have been struggling today. All right. Aussie, New Zealand dollar, bottom of the pack. Dollar, yen, Swiss franc, top of the pack. Safe havens have been supported. Okay. So medium term, the outlook for the Australian dollar has been quite heavily sold. But the medium term outlook for the Australian dollar will be quite closely linked to stocks as well. Now, an opportune, say China recovers and starts putting in some gains, and we get a dovish pow, then you could look at maybe Aussie US dollar longs. But I don't like it because I think China's struggling, and they're struggling with that COVID zero policy, with the property market, like iron ore price is a bit pressured, copper price is a bit pressured. So I see, you know, a little bit of pressure in the Australian dollar, and that could continue. But I've got a neutral bias on the Australian dollar. It's been quite heavily sold as well now for some time, so it's sensitive to good news. Any good news could see it pop higher in the Aussie. Kiwi is tricky. Okay, Max. We had a hawkish tilt from the RBNZ their last rate meeting earlier in the month. You'd never believe it though, would you? This is the basket of New Zealand dollar, and yeah, it's fallen lower. Sometimes the RBNZ is a difficult central bank to trade. Now, at the end of last year, around November 2021, the RBNZ turned the most hawkish central bank in all of the major central banks. And look what the New Zealand dollar did. It flumped from 120 down to 75 before making up those gains. Now I was long the New Zealand dollar yen during this period, and it was a very painful trade. So I'm skeptical of the RBNZ, Max, because they kind of have made this hawkish tilt, but it doesn't always equate into New Zealand dollar strength. So I would just trade the New Zealand dollar in line with risk tone. If risk is positive, you want to be long New Zealand dollar, Aussie dollar. If risk is negative, short New Zealand dollar, Australian dollar. And, you know, I'd be looking at trading at pairs like, you know, if risk is off, I'd be looking at trading New Zealand dollar, Swiss franc, Aussie dollar, Swiss franc. So today, like, not that I did trade this, and I wouldn't recommend it trading it, but you want to short something like the Aussie Swiss franc short, New Zealand dollar Swiss franc short. Okay, that's the kind of trades you're looking at here. This is your risk on, risk off, you know, trades, and we should be seeing a return to risk on, risk off trading now. Hope some of those thoughts help, Max. Yeah, okay. I always assume low inflation in New Zealand and the RBNZ does not want to be really hawkish, no matter how hawkish they sound. Well, it's an interesting view, Max. There's obviously something going on. I'm not sure if it's that, because yeah, inflation is a little bit lower in New Zealand, but the RBNZ said themselves they've been surprised at the domestic inflationary pressures, how high they've been in their last rate statement. So they are obviously a bit surprised by the inflationary pressures, and they're certainly not lower than Switzerland or Japan. So they are sitting in the pack. They're not as high as like the US and the UK for sure. UK it's over 10% now. US heading that way. So just that's my caution with the New Zealand dollar anyway. So, but sometimes if you've been burnt once, you can, you know, you can sometimes leave something aside, but you know, for not necessarily a rational reason. But that's my thoughts on the New Zealand dollar. Yeah, thanks for sharing your thoughts, Max. That's my initial response to that idea. And obviously, if you look at the RBNZ here, look, you can see that they're expecting interest rates to be like 4.54% for next year. So they're up 3%, expected to be 4.54, and if you compare that to like BOE, it's expected to be 4.09, ECB expected to be 1.9, RBA expecting it to be 3.68, SMB expecting their rates to be 3.25. You see what I mean? Even the Fed, if you look at the Fed, expecting it to be let's have a look. 3.45 by 2023. BOE expecting when's the first, possibly a rate cut middle of June next year, and we're still, you know, trucking our way higher. So you can see even now RBNZ has got that most hawkish terminal rate. When you look 1 year out for rates, is that really reliable? What you're looking at, Charles, is you're not looking, you don't look at these rates and go necessarily, aha, you know, the Bank of England's going to be, you know, 4.04% from March 2023. You're looking at, this is the expectations now for where the Bank of England will be in March next year. So remember, whenever you're trading, you never, like, even this chart here, like, let's just take dollar yen for instance. What you're not trading here, what's going on now. What you're trading is the expectations of what's going to be happening in the future now. So markets are always very, very forward looking. Okay, so all these gains in the dollar yen's all been on expectations of what the pound's going to do. And then the dollar yen will trade on expectations of what the dollar yen is going to do after Powell's speech. So it's not that you're looking for 1 year rates out and you think, aha, that's reliable in the sense of, you know, I can make my investment decision on that. Sometimes it can be helpful, but you're looking at expectations of what will be happening in the future. And the sooner you realize that markets are trading on future expectations, they're not trading on current realities. Does that make sense, Charles? Once you understand that, it will help you a lot, because you'll start to see, oh, hang on, you know, the price that I'm seeing now is not reflecting business conditions now. It's reflecting what business conditions are expected to be in the future. 1 year out is a function of market sentiment, which is fickle. Yeah, it's helpful though, because it's telling you what markets are expecting now. Now, as traders, that becomes really useful, right? So let's give an example. So say the Bank of England, next meeting, we've got expectations that there's going to be a hike of 100% for a 50 basis points rate hike. So that tells you if they only hike by 25 basis points, you know, you've got all that to be priced out. So you can see a lot of downside in the pound. You see? And say the RBNZ, say you know that sterling markets are pricing in expectations of 4% in 2023, but say the RBNZ, something's come out and say, actually, we're seeing interest rates down at 2%. Then all of a sudden, you've got a great opportunity to sell the New Zealand dollar. So you're not using, yeah, understand, yeah, well done, Charles. But you're not using these projections as something reliable. You're using it as something to inform you of what those future expectations are. And then as market sentiment diverges from those expectations, that's when you get the opportunity. So that's why the best opportunity this week is going to come with Jerome Powell is dovish, because that's not what's being expected. Markets are trading now on the future expectations that Jerome Powell is going to be hawkish, right? So if he ends up being dovish, then all this has got to be undone. Yeah. Folks, great. Charles, good questions. Max, good questions. Really fruitful discussion. Don't forget, I won't be here this Monday, unfortunately, because it's a bank holiday, but I will in the UK for this Monday. But I am scheduled to be back here on Wednesday. So please, thank you very much for attending. And I look forward to being back here for Wednesday. And we will be getting ready for the non-farm payroll. We'll be digesting everything that the Fed has decided. And we'll be getting into what the next opportunity is. Don't forget to have a look through this recording if you need some assistance for what opportunities they are. Max, thank you very much. Good questions. Thank you, Charles. John, good to have you. Salvatore, as always. Samir, Ignatius, Charles, take care. Have a very good session. Thank you all very much. Goodbye now. Oh, for those of you around, I will be CNBC Arabia at 3 o'clock, 3:15 today. Thanks everyone now. Goodbye.